Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 28th year in business. It's Thursday morning, March 9th, 2017, and the title of this week's audio blog is The Most Overdue Financial Crisis in History. Well, I won't lie to you, this week has been miserable, as after starting the year well, yet another cartel fleecing has played out in the same tired fashion we've observed for the past 2 decades. I.e., amidst some of the most bullish political, economic, and monetary fundamentals imaginable, precious metals rise, coincidentally, to exactly their 200-week moving averages of 1260 per ounce and 1860 per ounce respectively, i.e. the exact same levels they were trading at on Election Day, just before the violently precious metal bullish Trump victory. You know, the guy who has since ended the 2-decade propaganda meme of the strong dollar policy. The cartel managed to enact yet another successful named storm blitzkrieg attack. In this case, what I have deemed the 200-week moving average war raid. Anyhow, as gold and silver recover those massively cartel-suppressed post-election losses, the COMEX's commercial short position, and I put commercial in quotes as there is nothing commercial about the Wall Street banks, i.e. government partners in crime, as always rose in lockstep with precious metal prices, with silver's short position actually reaching an all-time high level a week ago. Which, when noted under the backdrop of Bixrio's latest Roadside Chat podcast, which noted that COMEX silver trading activity rose by a whopping 40% in 2016 alone, couldn't better connote the infallible smoking gun manipulation evidence mining companies could use in court to prosecute if any had the motivation to help their investors, let alone survive. Heck, in 2005 or so, Barrick actually admitted to manipulating the price of gold down, but let's not talk about such truths for now. Well, thankfully for precious metal owners, these mining CEOs haven't, because as a result, production in both gold and silver peaking in 2015 are en route to cataclysmic 20 to 25% declines over the next decade. This, whilst demand, which already achieved a record high level in 2016, is set to parabolically explode as history's largest, most destructive fiat Ponzi scheme implodes. Back to the shorting. There is no guarantee that such activity will lead to a price smash, as at times, like in the first half of 2016, and particularly the spring of 2011, when the cartel was forced to cover its massive silver shorts as silver rocketed to $50 per ounce, the best-laid manipulative plans simply don't pan out. And this time around, when the inevitable short squeeze occurs, there won't be any fake Osama bin Laden captures to use as evidence, as cover to smash the price back down again. However, amidst this miserable, world-destroying two-decade snapshot in manipulative history, particularly since said Ponzi scheme permanently broke in 2008, it has worked for the manipulators more times than not. And this time, last Thursday's $2.7 billion COMEX silver sell order, all within a half hour's time, with no other markets materially budging, did the trick, pushing gold from $1,260 to nearly $1,200 and silver from $1,850 to $1,715 in just a week's time. Which really hurts, I've got to tell you, but only empowers me further to step up the fight against the heinous precious metal manipulation that has enabled said Ponzi scheme, which must inevitably be won, just as all attempts to hold the only real money the world has ever known down. Particularly now, with more potential catalysts simultaneously lurking than any time I can remember, like next week's Ides of March, when the U.S. debt ceiling reappears for the first time in 17 months, the FOMC meeting sets the table for a catastrophic policy error, that is, if they aren't purposely tanking the economy as a political statement against Trump. And last but not least, the Dutch election kicks off what will likely be a year of European discontent on the road to the inevitable breakup of both the EU and the euro currency itself. During such times, especially here in the center of precious metal manipulation, where the real grand champion of currency manipulation, the Federal Reserve, does its dirty work, it oftentimes feels as if they always win. After all, the recently hyper-turbocharged PPT has not only pushed the Dow Jones propaganda average to new all-time highs, but did so amidst the worst political, economic, and financial conditions of modern times, to the point that unequivocally, U.S. stocks, not to mention those of other leading financial, economic, and monetary manipulators like Germany and the UK, are trading at valuations on nearly all metrics, exceeding not only the 1929, 1987, and 2007 tops, but even the tulip mania-like dot-com bubble. Bonds, too, given the massive, in most cases overt, as in Europe, the UK, and Japan, but in others covert, as in the US for now, NERP and QE programs utilized to LOL save their respective economies. You know, like putting cement shoes on a drowning victim. And even, despite what happened just 1 decade ago, real estate, albeit not the common Joe Sixpack properties as back then, but instead high-end properties only, owned by the 1% and financed by central banks' free money. And oh yeah, commercial real estate, which is literally 25% above the 2007 peak, despite the retail economy literally collapsing in front of our eyes. And it's not just the miserable economy, with the worst real labor market in generations, the lowest savings ever, and the worst outlook for the nation's youth since the signing of the Declaration of Independence, as is readily apparent in the earnings results and outlooks of major retailers from Target to Costco, Walmart, and Macy's, as this time such irreversible economic misery is being compounded by the secular trend of online shopping, which 1 decade from now will likely result in the closure of perhaps 50% of all retail malls. Not to mention the replacement of countless millions of the minimum wage workers that typically man them by robots and other forms of artificial intelligence, which, as I discussed in last month's Shocking New World audio blog, and countless other similarly themed articles and podcasts, is about to sweep the world virally, yielding tens, if not hundreds of millions of job losses, which in turn will yield a dramatic acceleration in the populist, protectionist, and otherwise draconian government movements, promising socialism or even communism for all, and consequently destroying what's left of the economy and the worthless fiat currencies underlying it. This at a time when, as noted above, precious metal demand is already at an all-time high, and oh yeah, due to last year's passing of the new Sharia law gold standard, hundreds of millions of new potential buyers will be entering the market. In other words, if you think they are winning, think again. As aside from said last-to-go markets, the average stock market topped many years ago, including most of those in mainstream Europe, for example, which for foreign investors have plunged much more than the headline numbers due to the catastrophic collapse of nearly all fiat currencies against the reserve currency dollar. For the millionth time, not due to U.S. economic strength, but the simple fact that the dollar is more liquid than any other digital toilet paper. To that end, even after this week's cartel smash, the price of gold in all global currencies is either near, at, or in many cases, well above previous all-time highs. Moreover, whilst the 1% receiving free, albeit rising, central bank money, PPT-injected liquidity and at times inside information of such criminality, the 99% have decidedly not, as most lost their shirts in the 2000 and 2008 bust, with the resulting economic crash suffocating any attempts they've made to recoup their catastrophic losses. This is why the powers that be are being serially voted out of office, starting with the Greek and Catalonian referendums of 2015, to the Brexit, Trump, and Italian referendum victories in 2016, to what will unquestionably be an historic election season in 2017 in Holland, France, Italy, Catalonia, and Germany. This as empirical evidence, not fraudulent, meaningless, soft data like confidence surveys, but hard data like industrial production, retail sales, debt accumulation, and real wages, not only screams recession, but depression, both here and overseas. Europe is on the verge of collapse. China just admitted to its weakest LOL growth in 3 decades. India is on the verge of revolution. South America hyperinflation. And the Middle East war. The latter as the oil PPT's last stand, i.e. the fraudulent, collapsing before our eyes OPEC production cut agreement that never was and wouldn't matter irrespective, which ultimately will spell OPEC's permanent death as a market manipulating entity, violently collapses before our eyes, yielding a horrifying European migrancy crisis that will make the current version, the one that catalyzed the Brexit and shortly the Frexit, pale in comparison. To that end, let's talk about the inflation the Fed is apparently so fearful of, to the point of raising rates despite its own economists lowering their 1Q GDP growth forecast yesterday to just 1.3%, following an equally miserable fourth quarter print of 1.9% and the full year 2016 result of 1.6%, double seasonal adjustments notwithstanding, i.e. the lowest amount since the great financial crisis. Not to mention simultaneous with said debt ceiling crisis, which without reservation I guarantee will be far more politically, economically, and monetarily damaging than the 2011 version. You know, when the U.S. was stripped of its comically undeserved AAA credit rating and dollar price gold and silver hit all-time highs. When said ceiling was just $14.1 trillion amidst a strong economy versus $20.1 trillion today amidst the weakest economy since the Great Depression. I'm not even going to discuss the lie that was yesterday's ADP employment report, which likely will translate to an equally egregious lie in tomorrow's NFP report. As at this point, it couldn't be clearer that the real condition of America's labor market, due to both the cyclical and secular factors noted above, is as bad as at any time in the last century. And if a bunch of employers' newfound confidence in the post-election world caused them to hire a bunch of new workers last month under the assumption that Trump will save the world, they're going to be regretting those decisions soon enough. Not to mention the giant pink elephant in the room of utterly collapsing hard data, from industrial production to factory orders, retail sales, mortgage applications, and even revolving debt. But don't worry, non-revolving debt, like government-funded student loans, is still soaring as desperate youth seek any cash they can get to pay their bills, given the soaring cost of living and bleak future outlook. And oh yeah, the catastrophic, life-destroying cost of education that will burden their finances for as long as they live. As for inflation, the fact remains that it has been steadily rising for our entire lives, as the Fed and other central banks have serially destroyed our currencies, but particularly since the 2008 crisis, when they have hyperinflated our lives into oblivion, which anyone not living in the reserve currency using US, i.e. the world's other 7+ billion people, are experiencing dramatically more, given that the average currency has lost roughly half of its purchasing power relative to the dollar over that period. And for those living in economies particularly relying on imports for basic necessities, said inflation has been catastrophic, as in Europe, which is exactly why the continent is on the verge of political, social, and monetary revolution. However, I agree wholeheartedly with Craig Hemke's recent article, The Sudden Onset of Inflation, which suggests that recent inflation data, at least here in the States, has been purposefully goal-seeked to just above the Fed's supposed 2.0% target to enable it to justify raising rates, even if such an action utterly annihilates America's economy through higher borrowing costs and a surging dollar. The latter of which will not only destroy an historically over-indebted corporate America at a time when its cumulative earnings have declined for 6 straight quarters to start with, but catalyze the inevitable massive yuan devaluation I first warned of in August 2015, i.e. the upcoming cataclysmic financial Big Bang to end all Big Bangs, which commenced 24 hours after that article was published, and is now up to 15% compared to the 30+% yuan devaluation I ultimately anticipate. Perhaps in 2017, if the Fed is dumb enough to keep up this hawkish charade, pushing the dollar above its 14-year high of 103 and perhaps even the 17-year high of 118 when an actual, per the title of today's audio blog, historically overdue financial crisis arrives. In other words, aside from price rises for specific reasons, like the catastrophic Obamacare premium rollovers from 2016 to 2017, which I assure you will never be repealed and replaced, and energy prices due to the aforementioned oil PPT's maniacal efforts to save the massively over-indebted energy industry, and specifically America's only remaining Middle Eastern ally, Saudi Arabia, which must complete the proposed $100 billion IPO of Saudi Aramco this year or face economic collapse, material incremental inflation, other than the aforementioned frog-in-a-pot slow increases, is hard to find. I mean, Walmart itself, just last week, said it is planning to not only reduce prices across the board, but pass through these losses to the massive supply chain it relies on. And clearly, one of the biggest components of the cost of living, housing, is on its way down, albeit from record high levels, as bubblicious real estate markets cool off and rents peak out due to all-time high housing unaffordability. Of course, Global inflation is a bit more tricky given the aforementioned rapidly accelerating collapse of dozens of fiat currencies, particularly those nations particularly reliant on imports of natural resources, like, say, Europe, China, and Japan. However, a quick look-see into the numbers reveals something extremely ominous for those claiming central banks are LOL ready to start tightening policies. Although in reality, it's only the Fed that espouses such lies, as not a single central bank, other than those like the Bank of Mexico, which are watching their currencies hyperinflate under their eyes, are doing anything remotely hawkish. Like the ECB, for example, which, as I write, just completed another policy meeting in which it uber-dovishly espoused its plan to maintain its historic NERP and QE programs for an extended period of time. To wit, last week's German CPI surged to its highest level in 3 years, which quite ironically was published simultaneous with a 7.2% plunge in industrial production, i.e. the same level of plunge as during the height of the 2008 crisis. Anyhow, embedded in said hawkish German CPI report, which apparently the ECB paid no heed to this morning, was the point that energy costs were the biggest component of the rise. Not to mention yesterday's biggest Chinese CPI surge of more than 7% since 2009, in which the largest two components on a year-over-year basis were energy at up 18% and ferrous, i.e. base metals, up 22%. And oh yeah, this morning's news, literally published as I'm about to tape, that U.S. import prices soar to 5-year highs as fuel costs spike. Regarding the latter, does anyone see that oil is free falling as we speak, down to $49 a barrel from $53 in the past 24 hours alone? Having not just broken below said oil PBT's year-long line in the sand at the key technical level of $50 per barrel, but sliced through it like it wasn't even there, and this as the COMEX commercials had an all-time high long position, if you want to know how much further there is to go down. This amidst exploding all-time high crude and gasoline inventories, plunging, in Goldman Sachs' view, stunningly weak demand, and the surging all-time high non-OPEC production catalyzed, ironically, by the price bump afforded by the fraudulent OPEC production cut, which, as always, is being massively cheated on, as evidenced by last month's all-time high OPEC production, let alone by non-OPEC partners in the agreement like Russia, which has yet to cut a single barrel of production, and oh yeah, the world's largest producer, the U.S., whose shale rig count is exploding anew, offsetting any cuts OPEC actually instituted with renewed production, particularly given the massive frac log of pre-drilled wells that were simply waiting for $50 oil to return to production. To that end, no one has been more bearish on the lie that was said OPEC deal than myself. And now more than ever, I believe crude is destined to revisit last year's lows in the 30s and perhaps even the 20s. In other words, the factor principally responsible for inflation rising above central banks' arbitrary 2% target is now in free fall mode. And as for the latter, base metals, I 3 months ago wrote about the massive bubble developing in copper, nickel, lead, and zinc prices due to the fraudulent, soon-to-be annihilated Trumpflation meme, which somehow is going to cause massive demand for infrastructure projects, despite demand many multiples higher in China for many years, failing to prevent base metal prices from plunging, as recently as last summer, to 2008 crisis-like lows. Anyhow, like crude oil, base metals are now in free fall mode as I write, having decisively broken below key moving averages. In particular, Dr. Copper, one of the world's most reliable industrial activity indicators, on news of the largest inventory build in 15 years last week to new all-time high levels. In other words, say goodbye to China's inflation surge too, at a time when its historic real estate bubble is rolling over as well. Not to mention, as the most deflationary demographic trends in global history, in the US, Europe, Japan, Russia, and yes, China are about to smash central bankers' 2% inflation hopes like a titanium 2x4 to the head, which will only hasten the aforementioned cataclysmic yuan devaluation that must mathematically occur, which, if this morning's yuan plunge above the key 6.9 to the dollar level is any indication, could come far sooner than the market expects. Then again, brain-dead, manipulation and propaganda brainwashed market participants don't have a clue what's actually going on, as they simply assume central banks will save the other people's money they manage in perpetuity by relentlessly placing manipulative puts onto the market in times of crisis, per the strategy created by Maestro Greenspan in 1987, when, within 1 month of his appointment as Fed chairman, the President's Working Group on Financial Markets was launched, and continued in accelerating Ponzi scheme fashion by his successors and their global peers for the decade after his retirement. Ultimately, hyperinflation will win the day, as his sinister, world-destroying progeny combat the aforementioned deflationary tidal waves in the same manner that all fiat Ponzi scheme-running central bankers have throughout history. However, until that time arrives, likely in lightning-fast fashion, as confidence serially collapses, the fight against deflation of debt, prices, and political regimes will be a decidedly losing one. Which brings me to today's principal topic, i.e. the most overdue financial crisis in global history, which not uncoincidentally will be the worst financial crisis in history as well, at least in modern times. To that end, even I am floored by just how massive the financial bubbles and key Western bubbles have become, from U.S. stocks to European and Japanese sovereign bonds. And yet, despite collapsing earnings, historic oversupply, imploding demand, free-falling currencies, and tumbling political regimes, somehow, last-to-go markets like the Dow Jones Propaganda Average have not only not had a major crisis in years, other than the PPT-saved Brexit aftermath, which lasted but a few days, but not even a 1% decline in 6 months or a 10% decline in more than a year? This as we head into the Ides of March period, in which a combination of assumed hawkish Fed speak, a potentially, or better put, likely catastrophic debt ceiling battle commences, and the European election witching hour commences in the Netherlands. This as the oil PPT collapses, and as well, per plunging commodity prices and increasingly lower odds of healthcare and tax reform and surging fiscal spending, the end of the fraudulent, born purely on market manipulation, Trumpflation meme. Not to mention, with U.S. GDP expectations already flatlining amidst America's LOL third longest economic expansion in the nation's 240-year history. Mathematically, this historic crisis must inevitably arrive, and when it does, it will smash into a world more vulnerable to economic weakness than at any time since the Great Depression, when, I might add, there was essentially no sovereign debt, care of gold standards that prevented it. To that end, even a small crisis will likely be enough to topple what's left of the dying banking system and the despotic, thieving governments that support it, or at least put central banks, including the Fed, into full-out hyperinflationary mode. And thus, the need to protect yourself from what's coming, financially and otherwise, has never been more urgent. And if your desired protection prescription is precious metals, we humbly ask you to call Miles Franklin at 800-822-8080 or go to milesfranklin.com and register for online purchasing and give us a chance to earn your business. And as always, I can be reached via email at ahoffman@milesfranklin.com. Thanks very much. Post-election losses. The COMEX is commercial short position, and I put commercial in quotes as there is nothing commercial about the Wall Street banks, i.e. government partners in crime, as always rose in lockstep with precious metal prices, with silver's short position actually reaching an all-time high level a week ago. Which, when noted under the backdrop of Bixrio's latest Roadside Chat podcast, which noted that COMEX silver trading activity rose by a whopping 40% in 2016 alone, couldn't better connote the infallible. Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 28th year in business. It's Thursday morning, March 9th, 2017, and the title of this week's audio blog is The Most Overdue Financial Crisis in History. Well, I won't lie to you, this week has been miserable, as after starting the year well, yet another cartel fleecing has played out in the same tired fashion we've observed for the past 2 decades. i.e., amidst some of the most bullish political, economic, and monetary fundamentals imaginable, precious metals rise, coincidentally, to exactly their 200-week moving averages of $12.60 per ounce and $18.60 per ounce respectively, i.e. the exact same levels they were trading at on Election Day, just before the violently precious metal bullish Trump victory. You know, the guy who has since ended the 2-decade propaganda meme of the strong dollar policy. The cartel managed to enact yet another successful named storm blitzkrieg attack. In this case, what I have deemed the 200-week moving average war raid. Anyhow, as gold and silver recover those massively cartel-suppressed smoking gun manipulation evidence mining companies could use in court to prosecute if any had the motivation to help their investors, let alone survive. Heck, in 2005 or so, Barrick actually admitted to manipulating the price of gold down, but let's not talk about such truths for now. Well, thankfully for precious metal owners, these mining CEOs haven't, because as a result, production in both gold and silver peaking in 2015 are en route to cataclysmic 20 to 25% declines over the next decade. This, whilst demand, which already achieved a record high level in 2016, is set to parabolically explode as history's largest, most destructive fiat Ponzi scheme implodes. Back to the shorting. There is no guarantee that such activity will lead to a price smash, as at times, like in the first half of 2016, and particularly the spring of 2011, when the cartel was forced to cover its massive silver shorts as silver rocketed to $50 per ounce, the best-laid manipulative plans simply don't pan out. And this time around, when the inevitable short squeeze occurs,